Welcome to an introduction to accounting brought to you by Parkbench Tutors. In this short podcast we are going to look at something called the accounting equation, which is at the heart of all the accounting that we do. And the accounting equation is simply stated as assets less liabilities equals equity. So I'm going to try and explain this in terms of what happens for a sole proprietor, in other words when one person owns a business. The assets are basically the money and the property and equipment and so on. Anything that the business actually owns is called an asset. In contrast, anything that a business owes, that's called a liability. And the owner's interest is called the equity. So basically what we're saying is what the business has, what it owns, less what it owes, must be equal to the owner's interest or equity in the business. So let's see if we can start this off with a few simple examples. Here we have a business, and the business is started by Catherine investing £2,000 of her savings to start her hair salon business. So the business at that point then has, if we just go to this cell here, cash, which is an asset of 2,000, and the equity, Catherine's interest in the business at this point, is also 2,000. So you can see then that the accounting equation at this point is balancing. It's got 2,000 on one side minus nothing because there's no liabilities, and it will equal 2,000 of equity. Now we have Catherine taking out a bank loan of 1,500 towards the purchase of equipment. So in this case what I'm going to look at is the fact that there is a loan here. Let's enter that. So if she has a bank loan, her own assets, or rather the business's assets, business's assets will increase by 1,500, but there will also be a liability of 1,500. So if we look at the accounting equation at this point, let me just find that thing. We have 3,500 minus 1,500 will be equal to, let's go back there, 2,000. So our accounting equation is still balancing. Catherine purchased equipment for the business at a cost of 2,500, paying by cheque. Okay, so now we need to look at this. So we have an asset of equipment which is worth 2,500, but at the same time the cash has gone down by 2,500 since she paid by cheque. So if I look at that, that's 2,500 as an asset less 2,500. So I've still got basically the same equation. 3,500 minus the 1,500 is equal to 2,000. In other words, the accounting equation still balances. Now let's look at this transaction here that takes place. Catherine purchases an additional piece of equipment on credit for £500. So her equipment values go up by 500, but her liabilities also increase by 500. So we can say now that her total assets are equal to 4,000, but her liabilities are equal to 2,000. So 4,000 minus 2,000 gives 2,000, and we've balanced her accounting equation again. Now for the last one. Catherine visits clients at homes and uses her own car valued at $5,000 for the business. So she can also state that her vehicle is a part of the business, and it would then become an asset of $5,000. Now remember that since it was her vehicle before it was to the business, given to the business, then that is also representative of her interest in the business. So her equity in the business goes up by $5,000 as well. So we can now say that if we add these up, the 5,000 plus the 4,000 gives 9,000, minus 2,000 gives us, now we've got to add these up again, 5,000 and 2,000 is 7,000, and our accounting equation balances, right? So each time we did this, right here, we started off with this one, the accounting equation balanced when she made an investment in the business. The accounting equation was balanced when she took out a bank loan. The accounting equation was balanced when she bought some equipment. The accounting equation was balanced when she bought an additional piece of equipment. And the accounting equation was balanced when she used the motor vehicle for the business, and therefore the motor vehicle was going to become part of the business, right? So that then represents, let me just highlight some of that, that's the accounting equation that we have at the end. And that's the equation at the start. And we could highlight it for all the pieces in between, but after each transaction the accounting equation balances. Remember then, assets, what the business owns, liabilities, what it owes, equity, the owner's interest in the business. So assets less the liabilities will be equal to the equity. Thank you.